Ever found yourself puzzled by the loan process in the United States? If so, you're not alone. The world of loans can seem like a labyrinth of paperwork, terminologies, and decisions. But here's the good news. It's not as complicated as it may seem. In fact, understanding the loan process can be your ticket to achieving your financial goals, whether it's buying a home, starting a business, or funding your education. Over the next 10 minutes, we're going to demystify the loan process. We'll walk you through the necessary documentation, the different types of loans available, the best banks and lenders, the application process, and much more. We'll also delve into understanding interest rates, repayment terms, and what to do if your loan is rejected. By the end of this video, you will have a concrete understanding of the loan process, so stick around. To begin with, let's talk about the documentation you'll need. The first thing you'll need to provide is a valid form of identification. This could be your ID, passport, or driver's license. Next, you'll need to show proof of income. This usually includes things like your recent pay stubs, W-2 forms, or tax returns. Now, lenders will also want to verify your employment. A letter from your employer or your work contract can serve this purpose. In addition, your credit score plays a significant role in the loan process. So, you'll need to provide your credit report or history. Finally, proof of address is often required. This could be a recent utility bill or your lease agreement. Remember, each lender may have specific requirements, so it's always best to check with them directly. Having all these documents ready will streamline your loan application process. Now, let's delve into the different types of loans available. First, we have personal loans, which are typically unsecured and can be used for a variety of purposes, from consolidating debt to funding a dream vacation. Next are credit card loans, where you're essentially borrowing money every time you use your card. Balances should ideally be paid off monthly to avoid high interest charges. Then we have home loans, otherwise known as mortgages. These are used to purchase or refinance a home. Auto loans, on the other hand, are for buying vehicles. They're often secured by the car itself. Student loans assist with the costs of higher education and typically offer lower interest rates and more flexible repayment options. Lastly, business loans provide capital to start or expand a business. They come in various forms, from small business loans to commercial real estate loans. Knowing the type of loan that fits your needs is crucial in your loan journey. Let's discuss the top banks and lenders in the United States. Chase Bank, Bank of America, and Wells Fargo are traditional institutions known for their wide range of loan options. They offer competitive interest rates and flexible repayment terms, making them a reliable choice for many borrowers. Citibank and US Bank, on the other hand, are renowned for their customer service and comprehensive loan offerings. They are committed to helping you find a loan that best fits your financial needs and circumstances. But let's not forget about online lenders like Lending Club and Prosper. These platforms have revolutionized the loan industry with their quick approval processes and user-friendly interfaces. They're perfect for those seeking a more modern, streamlined loan experience. Whether you choose a traditional bank or an online lender, remember to consider factors such as interest rates, repayment terms, and customer service. Choosing the right lender can make a significant difference to your loan experience. So, you've chosen a lender and a loan type. What's next? The loan application process. This can take place online, in person, or over the phone. Let's start with online applications, the most convenient of the three. Simply visit the lender's website, find the application form, and fill it out with your personal and financial information. For an in-person application, you'll need to visit a physical branch of your chosen bank or lender. Bring along all necessary documents like proof of income and identification. Phone applications involve calling the lender's customer service and providing your details over the call. Regardless of the method, you'll need to provide certain documents such as proof of income, proof of employment, credit score, and proof of address. After submitting your application, the lender will review your information and make a decision. Once you've completed these steps, the ball is in the lender's court. Interest rates can be tricky. Let's break them down. Now imagine interest rates as the cost you pay for borrowing money. They're usually quoted as a percentage of the amount borrowed. First up, we have fixed rates. Think of these as the steady ones. They stay the same throughout the life of the loan, making your repayment amounts predictable. On the other hand, variable rates are the wild cards. They can change over time, typically in response to market fluctuations. This means your repayment amount can increase or decrease. Now let's talk about APR, or annual percentage rate. This is the total yearly cost of your loan, including interest and fees. It's a useful tool to compare loans as it gives you the big picture. Lastly, we have compound interest. This is interest calculated on the initial amount borrowed plus all the accumulated interest. Over time, it can significantly increase the cost of borrowing. A good grasp of interest rates can save you from unpleasant surprises down the line. Now that we've tackled interest rates, let's move on to repayment terms. These are the conditions under which you agree to pay back the loan. They can take various forms, so let's break them down. First, there are monthly payments, where you pay a fixed amount on the same date each month until the loan is paid off. Then, we have installment loans, which are similar to monthly payments, but the loan amount, interest, and term are set in advance. Revolving credit is another option. Here, you have a maximum credit limit and can borrow within that limit as often as you like. Grace periods are a time frame after your due date during which you can pay without incurring late fees. Speaking of which, late payment fees are charges incurred when a payment is made after the due date. Remember, understanding your repayment terms is key to managing your loan responsibly. Loan rejection can be disheartening, but it's not the end of the road. It's essential to understand why your loan was rejected to address the issue. Common reasons include a low credit score, unstable employment, or insufficient income. Improving your credit score is a good starting point. Pay bills on time, reduce your debt, and refrain from applying for new credit to give that score a boost. Sometimes reapplying with a cosigner can help, especially if they have a strong credit history. A cosigner shares the responsibility of the loan, making lenders more confident in their decision. Don't forget there are alternative lenders out there. While traditional banks might say no, online lenders, credit unions, and peer-to-peer lending platforms may say yes. They often have more flexible requirements and may look beyond your credit score to assess your creditworthiness. Remember, a loan rejection is just a temporary setback. Before we wrap up, here are some additional tips and reminders. It's crucial to thoroughly read and comprehend your loan agreement. This document is not just a formality. It is a contract that outlines your obligation to repay the loan. If there's anything you don't understand, don't hesitate to ask for clarification. Stay vigilant and steer clear of predatory lenders who take advantage of loan seekers with unfair terms and high interest rates. Building a robust credit history is another essential step. A good credit score can open doors to better loan terms and interest rates. Start by using credit responsibly, paying your bills on time, and keeping your balances low. Lastly, don't forget about loan forgiveness and consolidation options. Some professions offer loan forgiveness programs, and consolidation can simplify repayment by combining multiple loans into one. These tips will help you navigate the loan process with ease and confidence. And there you have it, a comprehensive guide to obtaining a loan in the United States. From understanding the importance of gathering the right documentation, to exploring the various types of loans available and identifying the best banks and lenders. We've walked you through the application process, explained how interest rates work, and discussed various repayment terms. We've also provided advice on what to do if your loan is rejected, and offered additional tips and reminders to ensure you're well equipped in this journey. Applying for a loan can be complex, but with the right information and understanding, you can navigate this process with confidence. Whether it's for a new home, your education, a car, or starting a business. Remember, it's not just about getting the loan, but also managing it responsibly. Remember, knowledge is power, especially when it comes to understanding loans. Until next time, stay savvy.